Good evening, all. On behalf of NISM, I would like to take this opportunity to welcome you all for the today's webinar. The topics you must be aware: active and passive mutual funds. Myself, Amit Sayed, working with NISM. Along with me today, we have a renowned speaker from the industry who will be taking today's webinar. We have Mr. Sanjeev Mathur, a promoter of Syrian Motors. Before we begin, just allow me a quick introduction to our speaker. Mr. Mathur has over 30 years of achievement in developing B2B and B2C channels in BFSI industry in India and overseas. Sun F&C, Reliance Securities Limited, Cholamandalam AMC, and FBSB India. Mr. Mathur is today a passionate advocate of financial planning and actively works to spread financial literacy across the country. Mr. Mathur is also sought after external faculty member, known for his incised lectures on debt and equity markets and other varied aspects of the capital markets with National Institute of Securities Markets with us, which is a SEBI's initiative. He has also had lectures in Indian Economic Services, Indian Corporate Law Services, Indian Revenue Services, and Army Group Insurance Fund. Mr. Sanjeev also works with SBI, Aditya Birla, ICICI AMCs, HSBC, White Oak for training of their team members. Mr. Mathur holds a Master in Chemistry from Delhi University and MBA from IIM Kozhikode. Before we start, let me convey you what are the major areas which are going to cover today. As mutual funds offer investors a convenient way to invest in diversified portfolio of securities. Within this space, active and passive mutual funds represents two distinct investment strategies, each with its own approach and cost structure and potential outcomes. Today, our speaker will be discussing about those funds and how to go ahead and what are the benefits along with the statistical report which are present till date. We'll be taking all the questions at the end of the webinar, requesting all the participants to put their queries in a Q&A board so that we will come to know that you have queries and our speaker will be happy to answer all your queries. So without taking any further time, I would like to hand over the webinar to our speaker. Over to you, sir.
Thank you so much, Amir. Good afternoon, everyone. I hope, Amir, I'm loud and clear.
Yes, sir. Very much.
Yeah. Thank you so much. Everyone, it's a very interesting topic today, passive and active fund. Before I open the presentation, see, just because I've spent, so many years, passive investment, before I open the PPT, as I said, in a very English language manner, active is when you try to outperform something. Passive is when you go with the flow. That's a basic grammatical difference between active and passive. Okay. In a very simple layman language, passive investment is gaining a lot of momentum in the last couple of months, the last couple of years. In fact, in the last 4 or 5 years, passive investment will become the in thing. Everybody's talking about, I should have some part of my portfolio in a passive investment. But how does all this began, the debate between passive and active? Let me open the presentation and go step by step. Now, active versus passive, which is, a big debate. Before I start, there's a very famous hypothesis, which people might not be knowing, or you might be very much interested in understanding, known as the EMH, or the, efficient market hypothesis. Is basically a concept in finance that tells the finance markets are totally efficient and the prices of assets fully reflect all available information. Meaning where the price of the asset, whether it's real estate, whether it's equity, is perfectly priced. Whatever is available in the market, according to that information, the price, what is in front of you, is perfect. That's what this market says. Is basically divided into majorly 3 parts from where you'll both of passive and active will happen. First is a weak part. When I say weak, what does that mean? Stock prices reflect all the past market data, so technical analysis is ineffective. They basically don't take any technical analysis, charting, etc. into consideration. Semi-strong. Stock prices reflect all publicly available information, meaning fundamental analysis will not consistently produce excess returns. Here, the question of active starts coming in. So the role becomes how to outperform. So mispricing are available since markets are not completely efficient. There's just a theoretical explanation. I'll be getting into much simpler words also. Such inefficiency in the market can be exploited by using research, analysis, and timing to find mispriced security and generate alpha. When I say alpha, it basically means suppose somebody says, I'm going to give you a return or benchmark return is 10%. I'm going to give you an alpha of 2. And he gives you an alpha of 3. That means instead of 10%, the consistent fund manager gave you 13%. Suppose he gave the benchmark return is 10% and the alpha was -2. That means the benchmark gave 10% and the corresponding fund manager or the scheme gave a return of 8%. The excess return over the anticipated return over and above the benchmark is your alpha. Strong. Stock prices reflect all information, both public and private. That meaning no one can consistently achieve superior returns. What is there, you will get that only. So markets are completely efficient and it is futile to try beating the market. That is the basic concept of passive. Putting in simpler words, active is when you try to outperform the market, trying to take advantage of mispricing, incorrectedness, and passive is when you don't try to beat the market. Very simply putting it. Similarities of active and the differences. Let's look at the similarities first. In terms of flexibility, any investment fund can employ active or passive investment. That's a strategy. That's a fund house strategy, whether you want to have an active fund management, buy, sell, or a passive. Second, structured to use pool money from investors to buy and sell investment, securities to be held in the fund and share returns generated. Simple, the way any mutual fund function, they also function, whether it is active or whether it is inactive. Sorry, whether it's passive or whether it is active. Third, certain similarities, benefits such as diversification and professional management. Both are managed by fund managers. In one, active, the involvement of the fund manager is much more than the passive. I'll come to that also. Can share the same investment objective, such as growth, income. Like example, they can share the same thing. My scheme basically wants to generate a growth or they want to protect the capital. It can happen both in the passive investment and the active investment also. The major differences in the management style, how the funds are invested and managed. Actively managed fund, because you consistently try to outperform the corresponding benchmark. So you buy and sell to generate an extra alpha. So your cost might go up. The cost because of STT, the other taxation, they might go up. So you have a higher expense. Active funds have higher tax liabilities than the passive fund because of frequent trading, buying and sell. So you outperform the benchmark. That's the whole idea. Active funds generally attempt to outperform a market index, whereas passive funds try to match the performance. They basically match the performance. You have a 50 over match. You have to make 300 runs. A passive fund will make 6 runs per over. And so an active guy will try to complete the runs in 30 overs. He'll hit at 9 runs per over. The difference between an active and a passive person. Simple. Passive funds is a very famous thing. If you can't beat them, join them. When I said a lot of traction in the last couple of months is happening from the passive investment side. Why? Where? I'll just go one by one so you don't get confused looking at the slide. Hands-off approach. Investments, funds that replicate a market index. Example, I have a Nifty 50. Nifty 50 is my benchmark and I make an index fund which replicates the Nifty 50. That means, hypothetically speaking, if you have 5% HDFC, you have 7% Reliance, in my index also will be 5%, 7%. Okay, the timings might differ. So basically, a passive fund replicates a particular index. Fund replicate market index such as Nifty or Sensex. These funds invest in the constituents of the selected index in the same proportion as they're present in the index. Suppose the index changes, Reliance from 8 to 9%. In the corresponding index passive fund, it will change from 8 to 9. Comes to 9 to come to 9 to 8. Suppose HDFC, it's just an example, gets replaced by some other bank. Out here, it gets replaced. It basically marries, it copies that particular index. Imitate a market index composition. It's a co-joint twin. Transparent with lower market turnover, of course. Low tracking error. What is when I'm using the word tracking error? Because I'll be using this word quite often. Tracking error basically tells you the how much difference is there when you check the performance of an index fund. Index fund is a passive fund which basically copies a particular index. But index, suppose returns are is 8% HDFC, 9%, there are 50 constituents. Index fund also will have a 50 constituents, same proportion, but there can be a gap of timing of buying and selling. So that difference of return between the index and the particular index fund is your tracking error. It's calculated by standard deviation. We're not getting into those details today. Second, replicate market returns rather than beat it. They're not trying to outperform. They're basically replicating the particular index returns. Predictable performance. You know, the index will give you 10%. So my index fund or my passive fund will also give me 10%. Buy and hold strategy. You buy and hold. No in-depth research. You don't know. You don't having 100 stocks and you're selecting 40 stocks which will outperform than the others. So suppose it's a large cap scheme. So a large cap scheme has got 100 stocks. You're not doing a research which 50, 60 will do well. Out here, you're basically similarly copying whatever in the index is. So no in-depth research is required. It's already present. Lower cost and management fees. Lower expense ratio because they're not so much of trading, etc. happening. Okay. The fund manager involvement in a passive fund is very limited. Whereas in the active fund, the fund manager involvement is paramount because he buys, selects stocks with a lot of research. Let's go one by one. Risk associated. First is the market risk. They have a limited downside protection as they hold on to underperforming stocks. Example, you have a Nifty 50. Okay. Nifty 50, you have a passive fund, which is index fund of copying a Nifty 50. Nifty 50 goes down, your index 50 goes down. The fund manager doesn't have the choice here to change the percentage or change the stocks because it is replicating. Second, liquidity risk, which liquidity risk, whether you can sell, buy or sell or not. In extreme market scenarios like a crash, God forbid, a passive fund may face higher liquidity risk and demand for them will be lower. This happened during the 2008 crash, the Lehman Brothers crash. Concentration risk. When too much thing is present, suppose you have a particular index, a lot of banking is there, or a lot of some IT is there. That's concentrated. When you have a lot of stocks in one particular matter, many indices are weighted by market cap, meaning larger companies have a bigger influence on the index performance. Simple. Okay, the larger companies, like out here also, 37-60% basically the large companies. In large cap stocks also, 100 stocks, top 15 control the entire index. That's everywhere. Tracking error, which I told you. Due to costs such as brokerage fees, STT, etc., funds end up generating returns which differ slightly from the index they are following. Obviously, you're following an index, you're replicating the index, you buy and sell the stocks to keep in the same proportion. There can be certain charges, which is a tracking error. Understand, lower the tracking error, the better it is. That means that particular index fund is trying to totally replicate the corresponding index as a perfect passive fund. Volatility. Funds tracking niche or less diversified index, example, small cap or sector specific can be experienced higher volatility. I'll come to this. Passive funds types, which I've been telling quite often. Index fund, which I told before also, a mutual fund that replicates an underlying market index. Index funds can only be bought and sold at set prices and after the market closes and the asset value is announced at the NAV, at the day's end NAV. Suppose I buy at 3 o'clock or 2 o'clock, funds clear, I will get that day's NAV. That's an index fund. ETFs, which are again gaining momentum, are also kind of passive funds. Example, if I tell you so that you have no confusion going forward, example, I have a Nifty 50. I make an index fund, a passive fund, replicating a Nifty 50. So I have a Nifty index fund, example, okay? So I have the 50 stocks, I buy that NAV. Whether I buy 10 o'clock or 3 o'clock, I will get that day's NAV, right? But an ETF is basically traded on the stock exchange. That means a demat account. So your timings, what somebody buys at 9, 9:15 will differ. Somebody buys at 10, 10:30, 11, 12:30 till close of market hours. That's an ETF is. ETF is, or exchange traded fund, which is again gaining a lot of momentum, is a mutual fund that tracks an index but require a more hands-on approach to management, as they can be bought or sold at any time during market hours between 9:15 and 3:30. Funds of funds, another passive fund. Unlike an index or an ETF, a fund of fund may or may not necessarily track any index. These schemes invest in one or more mutual fund schemes. Smart beta. It is neither passive, neither active. It behaves like a passive fund, but it picks up the momentum stocks in the passive fund to generate a slightly higher return. Slightly more active, but still passive. They are non-conventional funds that mix the benefits associated with passively managed fund with selection of active investment on the basis of some criteria. We're not going to criteria, just to understand. I have certain examples here. These are just illustrations. They might not be replicated in the future, just for information. Example, I've given index fund example. Inception, SBI Nifty index fund, just a hypothetical example. Benchmark is Nifty 50. Benchmark 3 return for 15.17. Fund return 14.51%. Expense ratio 0.09. Expense is very less. Nippon ETF Bank, Nifty Bs. Okay, Inception Bank Bs. May 2004 launch. Nifty Bank is the benchmark. 13.08 was the return of the benchmark, but the fund return is 12.85. The difference between 15.17, 14.51, 13.08, that difference is basically tracking error. 0.19 is the expense ratio. Quantum multi-asset fund of fund. Benchmark 10.86, return 11.86, outperform the benchmark. Nifty 50, the smart beta, 19.94, 19.35 is 3 return. How to replicate the particular index? That's the beauty of a passive fund. Passive fund pros and cons. What are the advantages and disadvantages of a passive fund? Just go one by one. Obviously, low operational cost result in lower expense. You're not buying and selling, you're simply replicating. There's no less cost of the fund manager. The fund manager is not really involved here. So low operational result in lower expense ratio. The expense, that's why I said, if you go on the previous slide, is 0.09, 0.19. It can't exceed 1% for that matter. It is that way. Pros, less buying and selling of securities translate to fewer capital gain distribution. Hence, they are more tax efficient. It's a debate, more tax efficient. Easily manageable, as one does not need to track the performance of the fund or its fund management on a regular basis. You know what the index is, obviously almost close to the performance of the corresponding index. There's no fund manager involvement as such to outperform that. That's a passive. The risk of underperforming due to individual fund manager decision is lower. Fund manager can't decide, oh, I'll change the ratio. He cannot. Cons. There is no opportunity to outperform the market as passive funds are following a benchmark. That's a disadvantage. You can't. They tend to have higher concentration risk, particular market cap weighting. I'll come to this. Passive investment doesn't allow for customization based on individual preferences. Index, that's what it is. Index 50 stocks, these are stocks that will be on the index. Simple. No flexibility to fund manager will lessen impact of market decline. The market goes down, all the 50 Nifty stocks go down. Nifty 50 is just a hypothetical example I'm using. It can be any index. It goes down, entire stocks goes down, so index fund also goes down. Corresponding ETF might also go down. Because the fund manager can't say, oh, this is going down because of ABCD Bank, let me reduce the exposure. He cannot do that. Because basically marrying that particular index, that's what passive investment is all about. Just a story, the Indian story. The first passive fund, basically, if you look at this graph, though there are many other after 2019, RDBI Principal Nifty came, which got merged with Sundaram, etc., the other mutual fund. Then 2000 came Nifty Bs. Then 2005 came Gold Bs, ETFs. 2015, Employee Provident Fund starts to invest in ETFs. Why there's so much of, I'll come to that. Bharat Bond ETF is launched. Despite a history of 2 decades in India, growth in passive assets picked up only in the last 5 years. As I said, last 5 years have been phenomenal for passive investment. The change in the psychology of the entire investor, information availability, learning, education, investor becoming more knowledgeable. It's adding to that. The share of passive fund and mutual fund assets grown exponentially in the recent. Key growth factors are what has led to the growth. In 2050, a provident fund trusts were allowed to invest in equities mostly through ETFs. The Employee Provident Fund Organization, EPFO, the largest provident fund in India, chose to invest 15% annual funds via the ETFs. That means via the passive fund route. The government's use of ETF to sell stakes in public sector enterprises has boosted passive fund. Notable example include Bharat 22 ETF, etc. Uniform categorization, this is more technical, by the Security and Exchange Board of India has also indirectly contributed to the growth of passive funds. If you notice, share of passive fund and mutual fund assets. Today, the assets of mutual fund in India mark to market is 65 lakh crores as of last week, plus minus here and there. The percentage holding is 18% of 64 lakhs or is today passive funds. In 2019, the percentage holding only 5.8%, 5.8, 7.4, 10.2. Today, 17.5 and it's rising. 18% of the total mutual fund assets in India are basically passive funds as of today. Invest outlook. Why investors are having a look at passive and why you people are there listening to this passive and active debate. The market share of passive with the mutual industry, as I said, has grown 1 point in 2015 to 17% today. Look at the growth. It's a staggering 53% CAGR, compounded annual growth rate in the favor of the passive fund. In financial year 2018, the aim of all passive funds together was 80,000 crores, which is now 11 lakh crores as of August 24, latest last month, swelling 13x in just 6 years. Last 6 years has been phenomenal for this. Now, what has led to this? There was a research done by this is Motilal Oswal research. Investor preference. They said the cost is low, expense is low, that's why we invest in a passive fund. 56 is very simple. You just log in. If you're doing an ETF also, your demat account, go online, simply click of a button, it's done. 54% market, they feel that the market has given, index given better return than any active fund. Selection criteria, 68% expense ratio, because India is a very cost sensitive market. All of us are very cost sensitive. It's a behavior, classic case of behavior finance. They're very cost, the sasta hai wo bikta, the cheap, it is better. It is that way. Not necessarily out here. It is very visibly true. 60% they say expense ratio is low. That means I'll get a better return. Let me invest in a passive fund. 58% the brand of the mutual fund, how large it is, how known it is backed by some big entity brand. 43% fund size. Is it 100 crore, 1,000 crore, 10,000? Larger, the better. There's a feel of the investors. Might not always be true, but that's what the investors feel. 30% tracking error. Return, if you notice, 50% market and 34% tracking error. But index gave me 14%. This is giving 13.9. The others giving 30. Let me go for 13.9. How far? A recent survey of 2,000 investors, Motilal Oswal Mutual Fund, concluded 16% invested in at least one passive fund. That means if there are so many folios in the market, 61% people have invested at least in one passive fund. If you notice portfolio allocation, just for some figures which I got a couple of days back, passive investors portfolio allocated, 47% have got 10 to 30% allocation in a passive fund. Passive, when I say it can be ETF or non-ETF passive fund. 15%, 31 to 50%, 12%, greater than 50%, 28%, less than 10%. Investor understand, and just a note, investor might be better off choosing a fund with a low tracking error. A low tracking error indicates the fund closely follows the benchmark, while a high tracking error suggests more divergence. So that means not tracking the particular index properly. As I said, passive fund can be an index fund or many other, which is follows a passive strategy. ETF also follows the particular strategy. Passive, just to narrate the entire thing. Example, a passive fund, ETF versus index, exchange traded fund, stock exchange, as if bought and sold fund house. Let's go to this functionality of an ETF and index fund. What happens, as I told you, when you buy an index fund, you can buy on the NAV basis. You can't buy today, sell tomorrow, say after. You don't need a demat account in a mutual fund. But for ETF, you need a demat account. and you can buy at the real prices anytime between 9:15 and between 9:15 and 3:30 on a market day, when the markets are open. Real-time trading price throughout the market hours of ETF, yes. Index fund, no. Ability to put limit orders, ETFs, yes. Not an index fund. Can be traded real time? Yes, yes, yes. Exit load is not there in ETFs, but in index fund, the exit load may be there. Demat account is required in ETF, but not required in an index fund. Gold ETF. Gold investment through ETF is also gaining momentum. It's also passive investment, so getting exposure to another asset class known as gold. Gold exchange traded fund is commodity ETF that holds gold derivatives contracts backed by gold. They track the Indian gold prices. India's first gold ETF was launched by 2007 by Benchmark Asset Management Company, long time back. Today, there are more than 10 listed gold ETFs, which collectively hold 34 tons of gold. That means the investment value in this gold ETF amounts to 34.2 tons gold, equivalent to US dollar 2.1 billion. That's the beauty. That's why your passive funds are rising. Bharat Bond ETF. Bharat Bond ETF is India's first corporate bond exchange trade fund. It invests in bond issued by public sector. It aims to track return provided by Nifty Bharat Bond Index. The fund had defined maturity April 23, April 30. Fund is managed at a very low cost of 0.00005%. Now, active versus passive. The Indian market, August 2024, latest figure. Assets in passive fund reached an all-time high, which I told before, also 11.21 lakh crores, led by positive inflows in this category and M2M, mark-to-market gain. When market rises, your value rises in the underlying market. Other ETFs saw the highest inflow of around 10,000 crores. The appeal of it lies in the low cost structure, low expense ratio. As most of the people invest, 64% invest because of the low expense ratio, which I told the investor, which I told you some time back. 5 new fund offices, each in index and other ETFs category, launched in August alone. 7 are coming in September, collectively mobilizing around 900 crores. Gold ETFs saw their highest ever inflow of 1,600 crore, pushing the asset in this category to 37 or around 37,000 crore. That's the size of ETFs, gold ETFs in India. As gold prices climb and is appeal as a safe haven asset, standard because of war scenario, other market scenario. Okay, yesterday the rates were cut in the US by 50 basis points, etc. But still, people were a little worried. So gold became always a hedging instrument. Adopting a diversified investment approach, the surge in interest was further driven by a reduction in customs duty on gold from 15 to 6% announced in the budget. That's helped. People are buying gold. People are buying gold. And best part is people now are moving from physical gold coins, gold bar, they're moving to gold SIPs or gold ETFs, which is a passive way of investing. Just a success story. The very famous mutual, one of the world's largest mutual fund, Vanguard. They were the pioneers in passive investment. Bogle, the founder of Vanguard, there was a Bogle theory also. There's the idea of passive. After many actively fund, they thought that many actively fund management consistently failed to outperform the benchmarks over time. This might not be always true, but yes, there was some theory that says over time, because of high expense ratio, which builds on the returns, so returns fall. His thesis was that due to market efficiency and the high cost of active management, most active funds will struggle to beat the overall market. That's why years back in 76, Vanguard 500 index fund was launched. Key strategies and success stories. I will just read a few major points. Core strategy has always been minimizing cost. They minimize the cost structure. When you minimize the cost structure, it basically automatically builds in a better return. The Vanguard 500 index fund has an expense ratio of around 0.04% 23, compared to average fees of active, this is from the US, which can be as high as 1 to 2%. So straight away, 1% difference in return is huge for a larger amount. Unlike other investment firms, that particular trade and privately owned, Vanguard is owned by investors in its funds. This mutual ownership ensures the company operates on a low cost, etc. Vanguard used efficient market hypothesis to back a strategy, citing numerous studies showing that over time, very few active manages to beat the market after cost per account today. Results and impact. Vanguard asset management have grown exponentially. As of 2023, Vanguard managed over 8 trillion in global assets. They're so huge. We are nowhere near. Okay, with one single is so large. Passive strategies have grown significantly in the last 2 decades, with passive mutual fund ETFs now accounting over 40% of the US and assets. In India, the way it is growing, the day is not far away when we will also be so much. Up less than 10% early 2000. In the last 5 years in India, from 2% to 17%. In the US, in the last 15 years, from 10% to 40%. So growth in passive funds has been phenomenal, which you're witnessing today also. You and me both are witnessing that. Results and impact. As passive investment become more popular, critics argue that too much money flowing into index fund could distort market pricing mechanisms. It's just a thought. Critics argue that it may underperform during market bubbles or speculative rallies. These are speculations. Active. We discussed of passive. Let's move to active. If you can outshine them, why join them? Very simply putting it, I talk about passive, basically fund manager role is limited, you copy a particular index, etc. Investment fund individually select securities to beat the intended market index or benchmark. Active funds are directly managed by a manager or a team of managers, fund manager. Their role is to outperform the benchmark and to give the investors a higher alpha or a higher return than the benchmark. Enjoy a variety of strategies to construct and manage a portfolio. They have the choice. They want 5% of this, 6% of that. From that, they can do it. Less transparent with the higher turnover. They buy, sell, buy, sell. They don't tell you what I'm buying, what I'm selling. High tax liability, STT goes high, transaction costs go high. Outperform the benchmark index or market average. Performance highly dependent on the skill and decision-making ability. Suppose I have to choose 50 stocks out of the large cap, which are 100. The fund ability, team's ability, which will outperform, which bank will outperform, which other sector, which I should go heavy. Lot depends on fund managers actively managing. Security is selected after extensive security analysis and research and market forecast. Higher cost management fees, people are involved. High expense ratio, buying, selling, high expense ratio. Types of active investment strategies. Bottom up. You keep hearing, see, I talk about passive investment strategy. Let's talk about just going a little diversify here. The types of active investment strategies. Bottom up. Selecting individual stocks based on their fundamental and growth potential. However the economy is, however the markets are, you feel the stock is good, this potential, it will rise, that's a bottom up. Top down. You look at the economy, then go downward. Analyzing macroeconomic factors, was the GDP, was the IIP, etc. Numbers, then you decide. And as a matter of fact, and trends to identify sectors and regions with favorable prospect. Or rains were good. Rains were good. It was more to agriculture stocks might do well. Okay, the interest rates are good. They're going down. Banking might do well. Real estate might do well. Top-down approach. Factors-based. Exploiting systematic sources of risk and returns such as value, momentum, quality, and size. Activist. Taking large stakes in underperforming companies and influence the management. Boss, I am buying a stock of your company. Okay. I'm going to influence, come on the board and influence so your company does well, indirectly stock prices rises because it's my portfolio, so my investors get a better return. Activist. Shorting, selling bought securities, this I will not talk about. Arbitrage. Exploiting price differences between related securities or markets. Like in the good olden days when I was starting off, arbitrage used to be buying in BSC, selling in NSE. When NSE had just come, so the difference in price. Suppose an A stock, price in BSC is 100, price in NSE is 102. We used to buy in BSC, sell in NSE. That's arbitrage. Right now, I have arbitrage funds also, which takes the advantage of the future prices. Leveraging, borrowing money for investment to amplify returns and risk. But please, as an individual, you should not borrow money and invest. This is on a corporate basis. Active funds, pros and cons. Potential to capture pricing opportunities and outperform the market. Fund manageability, he sees, oh, I'm in a diversified fund, large cap diversified fund. I think so the banks will do well. Let me go for that. Pros, investors can get reap benefits of professional management. Fund manager's role is coming. He's applying his mind, which portfolio do well. Allows for more tailored investment approaches, including focusing on specific sectors, themes, or investment style. automotive, gold theme, real estate theme, example, a diversified fund, mid-cap fund, etc. More flexibility to change allocation in response to adverse market events. Suppose he feels that the interest rates are not going anywhere, I have to go low on the banking sector, he can reduce the exposure, which is not possible in passive. Cons. There is a no guarantee of outperformance. Nobody can guarantee. It depends on the fund manager's ability and the markets perform by maybe inconsistent. High operational cost. Research results in high expense ratios. Buying, selling, expense ratios, because that's the expense ratio is higher. More buying and selling of securities translates to higher capital gain distribution, resulting in more taxable events. It can happen. Vulnerable to human bias like greed, fear, etc., leading to poor decisions such as bad timing, poor selection. Everybody is human. They can make mistakes. Greed. Oh, banks are doing well in portfolio. Let me go heavy. Suddenly banks collapse. What happens? Or one particular sector collapses. What happens? Ultimately, it's a person dependent, which is not in passive fund. Passive fund simply replicate a particular index. So that's the basic difference. Whereas an active fund basically tries to outperform the benchmark to give you a higher alpha. And a passive fund basically tries to replicate a particular index. It's moderate in nature. Active types, most mutual fund except index and ETFs are actively managed. There can be equity, debt, hybrid, money market, commodity, etc. ETFs, nowadays few ETFs can also be actively managed. There are few active ETFs also. Alternative, AIFs are gaining momentum. They are privately pooled investment vehicles that employ complex trading strategies. AIFs include private equity, venture capital, etc. Smart beta, as I told you, it can figure in both passive and active. They are non-conventional fund and makes the benefit as a passively managed fund with the selection of active investment. Examples are given. If you notice, we just taken this as an example. SBI long-term equity fund, 99 was launched. BSE 500 is the benchmark. 7.85% was the benchmark return. But the fund return is 26.63. Look at the difference in returns. That's outperformance. That's generating a higher alpha. Lot speaks about actively, lot speaks about the fund management. Coming here to UTI Nifty 200 momentum, 16.20. Look at the difference. Again, outperformance from the benchmark, which is not in the case of passive. Passive basically marries the benchmark. That's the whole difference. But out here, the risk can be slightly higher. Active fund, the Indian story, just like over the years, the markets are growing more efficient. The hypothesis, driven by various regulatory reforms introduced by SEBI, law reforms are coming along with enhanced transparency, increased participation, broader research alpha, education. People are becoming aware. As a result, it has become increasingly difficult to outperform the market, making it more challenging. Actively managed funds usually perform better than their benchmark during bear market. It's just a research. It might not be always true. It's just a research. Compared to bull market, during bull phase, large cap equity tend to underperform more. It's not always the case. While mid and small cap fund have shown less outperformance. So they have outperformed. Both have underperformed in bull market, but large cap has underperformed more. Large cap funds have lagged the most, particularly in the scheme recategorization. Different story. This recategorization restricted large cap fund from investing more than 20% of their portfolio in lower capitalization stocks. You have to be careful. The rising tax and capital gain distribution, these are all the paraphernalia which comes with active fund management. Okay. If you notice, share of active fund in mutual fund assets, has dropped from 94 to 82 because 82%, this similarly 7.5% is passive. So passive is gradually rising. People thought process that why not invest in index fund or a passive? It is that. Just a thought. At investor's perspective, we talk about investor perspective in a passive fund. Let us talk about what does an investor think from an active fund. Our research was conducted at CRISIL of around 132 financial advisors. Not a very big sample size, but big advisors who handle a lot of clients. So key factors for actively managed fund underperformance to their benchmark. Narrow breadth of market performance. Second, fund manager inability, blamed on the fund manager. Rationalization of mutual categorizations of mutual fund categories. Other factors. Key factors that increase the possibility of actively managing fund outperform the benchmark: fund selection, increasing investment horizon. The longer you remain, the better it is. Okay. Performance underlying the market, bull and bear phase, other factors. IFA advise passive fund as part of wealth planning to their investors. Feel that passive managed debt fund should be part of the active. In previous times, basically fund the distributor or the advisor was very reluctant in basically pushing for an active for passive fund. But now they realize For the client, passive investment is also important. That's a passive investment becoming a very important part of the portfolio. Everybody should have a certain allocation depending on your risk, goal, and your risk profile, etc. On your goal and your time horizon. Some allocation passive fund also. The champion basically. Notable traits just for your academic knowledge, which I'm talking about. According to Berkshire Hathaway 2021 annual shareholder letter, Buffett's company spent $31 billion to acquire so many shares of Apple. Now look at this, equates to a market value approximately, I'm not reading the figures, 158 billion and an annualized gain of 127. This is all about active fund management. I just go to the other one, this will come. Active global outlook. How the global outlook, that slide was not necessarily, honestly. 2023-24 trends. In 24, total passive in US passive strategies. Now, please understand, India is falling very closely. Surpassed those in active ones in the first time. That means out there, the passive strategies are more than active, which is gradually catching up in India. About 50%, 57% of active strategies survived and beat the average passive during 23 to June 24. So that doesn't, rules out that always active will underperform, active also outperform the passive in most of the cases written here very clearly. June 24 marked the end of an outside 12-month period for active bond manager, which 2/3 outperforming the average passive counterpart. Nearly 53% of active large cap equity funds outperformed the average index tracking counterpart in the 12-month leading up to June. That means again outperformance by active. While large cap manager and small cap managers perform well, mid cap and lagged at 36%. Long-term trend, the long-term performance of active fund has been underwhelming. Only about 29% survived and outperformed the average, not very good data. Over the past decade, the average dollar invested in active fund outperformed the average active fund in 1920. Active bond funds have performed relatively well. Over a this is just data, long-term with 38% achieving success. Long-term success in the large cap active category is rare. Around 50% active fund 15 years ago since closed. It's not happening, but it's happened. This is data available. What to expect? Understand yesterday, though this slide I was made 3 days back, yesterday the Fed cut 50 basis points, which has reversed the entire trend. Obviously, with another 1% expected, another 2% expected in 2026. So the period low interest rates, gradually from high interest rates started moving to low interest rates, was written as contrary. The period low interest rate and abundant liquidity following the COVID-19 pandemic is giving way to an environment of high interest rates. Again, that history now, we again getting into lower interest rate. This also might suggest we also might cut the interest rates. We do not know what happens in our policy. Wider will return the increased market volatility. So changing market conditions benefit active management. Understand. Now changing market dynamics, interest will go down. People will again go to active fund managers. So passive strategy just might take a slight break. But again, passive is here to stay. Active is here to stay. Again, political developments, at least 70 countries this year going for elections. So you've got to keep an eye on the active fund manager where you're deploying your fund. Geographical development, obviously tension Middle East, Eastern Europe, rise of ESG, growth in EV sector, renewable energy. A lot of things are happening in the favor of active, etc. So understand these things very, very clearly. Key metrics, my last slide, how to decipher. Asset under management, overall market value of asset capital that investment fund holds, often you indicate of size and success of the fund. A larger aim can lead to lower expense ratio per investors. Not always true, but larger size, the better. You should always look at the AUM. NAV, it is a market value of MF unit. It is the price at which an investor in mutual fund buys or sell unit. Not necessarily higher than the better. It depends on the fund. Load, fee level, the time, buying units from mutual fund, entry load, etc. The load, etc. in ETFs is not there. Okay, but expense ratio in passive funds is lesser compared to the active funds, which is mentioned here. Concentration ratio is much riskier in passive than active. Tracking error is basically when you track a particular index and its corresponding index fund or ETF. Lower the tracking error, the better it is. So just summarizing it very simply, because few slides are slightly complicated maybe for you. Fact is, passive investment marries a particular index, lower expense, lower thing you should have in your portfolio. Active basically tries to outperform for fund manager strategy, his selections role becomes paramount important, active fund management. That's the basic difference of the two. This is what the difference between active and passive is in a broader way. I'll open the house for questions, whichever you want to ask, you want me to elaborate, I'll be more than happy to elaborate. Again, before I go to question answers, NISM comes up with various certifications on mutual 5A and 5B. It's written in front of you. Anybody interested in becoming a distributor, anybody working in financial services, a mandatory certification, NISM 5 and 5B. There are a lot of e-learning modules also will help you understand the basic starter journey to know how to invest in a mutual fund. Anybody wants to understand the basic, they can go to the e-learning module. There are various introduction mutual fund types, how to invest, benefit, limitation, key features which are mentioned here. You can read it. 4 instructor-led based course, except 30 days for data registration, 100% online, fees is mentioned. Yeah. So you should definitely try all these things. I will open. This is what I had to add on active and passive. I've spoken enough, whatever I could translate into your understanding. Anything you want me to answer, you want me to make it simpler, I'll be more than happy to take up those questions. Thank you so much. Any questions, please? Any questions?
So we have certain question in chat board. Shall I read for you?
Yeah, please, because it hangs. One second, just hold on. 1 second. Yeah, I'll open it. Sure. Yeah. Amit, can read that because I'm just scrolling down. Can you read for me the question?
Sure, sir. Mr. Ankur Desai asks, I have been monitoring active and passive funds, but if I see return the ranking last month, passive funds return has come down compared to active.
Yes.
Sometimes it is easy to select active funds compared to passive. So, any inputs on that? Any you can highlight something?
Yes. See, I had a slide also showing that generally in a bull market, okay, sometimes what happens is the active funds underperform the market. Basically, see, understand one thing very, very clearly. It's basically a portfolio mix. It's nothing like a passive and active. It depends what kind of what kind of portfolio you're holding in your, what are the schemes you're holding in your portfolio. It's a mix of both passive and active. Active, obviously, suppose you have a large cap fund. I'm just giving a hypothetical example. Ankur has asked this question. Am I right, Amit?
Sorry, sir?
Ankur has asked this question. So
Ankur Desai has asked.
Yeah. See, what happens is active fund management, what happens is obviously the fund manager's ability to pick up the right stock from that particular set, which he is tracking the benchmark. So maybe he was able to select at that time, okay, because the markets are doing well, etc., which is not in the case of a passive. What I suggest you is always when you look at active fund management, okay, go for a 3 and a 5 year horizon. Ankur, if you're listening to me, go for a 3 or a 5 year horizon. 1 month will not be the right benchmark or the right focus area to judge an active fund. Go for a 3 year and a 5 year. That will, or a 1, 3, and 5 year. That will give you the basic analysis compared to the benchmark. Passive, yes, you can have a look at 6 months, 1 year, 18 months. When active, my suggestion would be 1 month will be a wrong way of looking at it. 1 month, a lot can change, a lot of volatility can happen, etc. So not 1 month, have a look when you're dealing with active, whether equity or debt, have a look at 1, 3, and 5 years. Ankur, I hope I made it clear to you.
Yeah, sir. Yeah. Mr. Manoj Kumar has asked, is there any concept of active and passive portfolio managers in the market?
Portfolio managers, see, I'll tell you. Can you elaborate on this? When you say portfolio managers, you mean to say the fund manager?
They have asked active and passive portfolio manager. Is there any concept of certain kind of things?
See, I'll tell you. Example, in an active fund management, you need a fund manager. Okay. Because suppose, I just give an example. Suppose it's a mid-cap scheme. Now, mid-cap has around 150 stocks in totality, out of which you have to select the mid-cap stocks. You can't invest in all 150. Okay. What do you call, you will select 50, 60. So fund managers know which 50, 60 will do well, which exposure should be higher, where the bank, where this should be lower, that should be higher. the fund manager role becomes very, very important. But in a passive fund, basic role of the fund manager is very limited. He's simply replicating a particular index which is already there. So concept of a fund manager becomes more important in a active fund than a passive fund. Passive fund simply replicates the particular index. Clear?
Yeah. So Mr. Vijay Kumar asks, what is the basic step to start knowing active, passive, and mutual funds? Means any precautionary measures or any differentiation you can
Yes.
majorly look for?
Yes. Yes. See, very simply putting it, first of all, I will say whenever you make a portfolio, okay, three things keep in mind: your age, your risk profile, your time horizon for, and what kind of goal you are having this. Your goal is, okay, after 10 years, I'm looking at a returns which will replicate Nifty 50. Go for a Nifty index fund or a Nifty ETF. Your goal is, for the next 8 years, I want to be safe, but I want to outperform the particular large cap. Go for a large cap scheme. First, take your risk profile into account. Then look at the number of years your goal is there. Look at the returns you're expecting. Then go backwards. Don't simply blindly put in. Yes, suppose you're a first-time investor. You're still testing waters. Start with a simple index fund, which will basically and through an SIP mode, which will basically replicate a particular index. That's what you should do it at an immediate basis. No rocket science. Don't have to complicate things in this.
Mr. Nishad Mullah has asked, can you just explain or elaborate expenses ratio in SIP per month deduct expense ratio amount? What should be
It is
ideally?
amortized. It is amortized. See, obviously, expense ratio, wherever you have an SIP, expense ratio comes into play. Okay.
Right.
Expense ratio with every investment you make, whether $500, $1,000, $10,000, it will come into play. It is not that, it will be, suppose doing an SIP of 1,000 rupees, it will only be deducted at the end of the 12 months. No. Every SIP you do, the expense ratio comes into play. Clear?
Yeah. Anai Kode Ramakrishnan asked, is there a passive investment for debt funds?
Yeah,
If
there is.
yes,
Yes, it is.
yeah,
The bond fund is there. The so Bharat bond is there. It is there, very much there.
yes.
Simply
Then
root.
in case if yes, now interest rates are going to come down frequently. Which
Yeah.
passive debt fund would you recommend for the 5 years,
Yes.
duration of
See, it
5
is a
years?
very difficult question. I can't recommend anything, but you ask me unofficially, yes. So it is that. Yes, I will recommend.
Then,
But go for a longer duration. Don't simply, but please analyze the risk before you do that. Okay, does that?
so Deepak has asked, where is the major risk factor involved, like in active funds or passive fund?
Yeah, this is risk is involved in both. Okay,
Okay.
risk is involved in both. Okay, example, you in passive fund, the only thing is that you are basically investing passive. You are not it's basically a scheme, okay, which is replicating index. And the index goes down, your passive investment also go down. Okay. In an active fund, the risk can be higher, can be lower, depending on the scheme you have chosen and the fund manager. So risk is equatable in both, but the return generation can be higher in active. That's why if you have a portfolio of 100 rupees, you should balance very, diligently between both an active passive. Risk is in both kind of investments. It's not only active will be, active can be only risk which comes in extra is the fund manager risk, the greed risk, etc., which can come because the fund involvement is there, which is trying to outperform the market. That will not be in the case of passive, but the risk still remain, the market risk still remain in a passive fund also. Clear?
Noted. So, Mohammed has asked, how should one decide between ETFs and index fund as a part of an investment portfolio?
See, I'll tell you the ease of investment. Ease of investment. If you ask me, ease of investment, ETFs is much more easier. It gives a flexibility of investment. Suppose I just take an example. You have a Nifty 50 benchmark, you have a Nifty 50 ETF, and you have a Nifty 50 ETF. Nifty, suppose today it is 12 noon in the market, Thursday, 19th of September. Okay. If I want to put in a Nifty 50 index fund, I will put in the fund, I will get today's NAV, right? Which will declare tomorrow, I'll get the NAV. But Nifty ETF, I simply go online through my broking account, whichever I have my account, simply look at the ETF which is being traded, go click of a button, I buy the units 1, 2, 3, 400, what is possible. It totally depends on you. ETF is more comfortable in buying and selling because you can buy real time between 9:50 and 9:15 and 3:30. Yes, you cannot do an SIP in ETF where you can do a SIP in an index fund. But if you ask me, both are easy, but ease of operation is more in ETFs. It is that.
Sir,
Ease of operation.
continuation for that, Mohammed has asked, Sunil Sharma has add on.
Pardon?
As your Sunil Sharma has make an add on that you have showed that risk are in both the types, right? Then and the returns which are not guaranteed, but as for let's say the top 5 in the category outperformance is surely much more than the expense ratio savings in passive funds. So why really one should buy passive funds?
See, I'll tell you. Why do you buy passive fund? Because 2 reasons. One, I'll tell you the one of the major reasons is people rooting a return like an index. He or she says, I'm very happy with what the index fund is going to generate. Index fund is going to generate 10%. I'm looking at 9.10%. I'm taking tracking error into account. I'm very happy. I'm not looking at outperforming the market, the hypothesis. For me, market is perfect. Everything's perfect. Nobody can outperform the market. Whatever data is available, that's the real price. He or she feels that I'm not going to look at, I'm going to balance my portfolio. I'm going to put in large cap, mid cap, but I'm going to put a part of portfolio in passive. Suppose it gives me 10%. I'm very happy with 10%. I'm not looking at 12%. That's the reason to balance your portfolio, you should put in a passive fund also. And yes, secondly, your expense ratios are much lower. When expenses are lower, that builds in the return. That adds 0.5 to 1 to 1.5% annualized to your return. So even if a benchmark does well, you're generating a decent return. So that's the whole theory behind the passive and active investment.
Noted, sir. Mr. Abhishek Patra has asked, how does the long-term performance of actively managed funds compare to passive funds, especially after accounting of management fees and market volatility?
See, I think it depends on fund manager. If you look at my slide, if anybody is listening, it got hanged. Active funds over a longer period of time have outperformed the market. Okay, have outperformed. I showed also. I took just an example. I'm naming a fund. It's just an example. Example was your SBI. Example of UTI. Both have outperformed by a colossal 4%, 6% over a period of 3 to 5 years. If the horizon is longer and your fund manager is up to the mark, then this 1% or 1.5% not make a difference. The return will be much higher. So if you're looking at longer term horizon, active funds are basically outperforming. That's why if somebody asked me also some time back, if you don't look at 1 month, look at 3 to 5, 6 years, 7 years for active fund, they have outperformed. And that's what the research in the US also, 54% have outperformed the large cap fund. There's a research also said some time back, which I showed you. Clear?
Noted, sir. So last 2-3 questions we'll be taking.
Yeah, sure.
Yeah. Mr. Rohila has asked, is there any passive investment involved in sovereign wealth fund?
I don't have, I think so, but honestly, Amir, I can note it down. I'm not getting an answer to this immediately. Okay. There is one fund towards gilt, which is a passive. Bharat extra, there is coming one into gilt fund only, but I have to check up and get back. If you can note it down, we can get back.
Sure, sir. Mohammed has again.
Yeah. There is. I'm not able to get the name.
Exactly. Okay. Mohammed has again asked, among several types of passive funds available, can he say gold ETFs are the best and safest investment?
No. Safest and best are 2 very different things. Gold, basically understand, we Indians buy gold on a very emotional, it took us maybe 70 years to graduate from physical to buying online. Okay, so gold, nothing like safety. Gold is a hedging instrument for us. Should be a part of everybody's portfolio. Safety, gold prices also have fallen. Gold price also risen. A gold price during COVID rose for 10 grams from 35,000 to 85,000, for 10 grams, right? So it was a huge, and now it's not rising that much. So understand gold safety hedging purposes. It should be a part of everybody's portfolio as purely as a balancing act. But you cannot say it is safe, etc. They can be, it depends on person to person, risk profile, background, etc. It is that.
So last two questions.
Yeah,
Is
please.
there any kind of fund which is hybrid form of both passive and active funds?
Yeah, I told you the smart beta.
Right.
Yeah. Smart.
Then
UTI smart beta is there. I'm just naming a fund, but still UTI smart beta is there. Yeah.
Mr. Sovik has asked, actually he's just started at the age of 30, that which one is most risk averse type of investment for the person who is risk averse
Can you repeat?
person?
If I can just, I just missed out. Can you just repeat again? So sorry.
Yeah, which one is the most risk averse type of investment for the person who is a risk averse person and new to market at the age of 30?
Which is the
So
most risk averse?
risk averse type of investment.
Go for a long-term index fund. Simple. Okay.
Okay.
Long-term
And the
invested
last
and
question.
invest in SIP mode. Keep doing a SIP. Don't shut it. Okay. Keep going for 10 years. That's the best. Simple. Don't have to look at outperformance. Simple.
Sure, noted, sir. We'll be taking the last question of Nachiketa Charan. Actually, she has a objective to build a corpus for the retirement, which is a long-term goal. So passive funds are better or NPS equity funds are better?
Both, mix of both. Mix of both. As I said, I'm reiterating, you should have a mix of both active and passive. So I'll just give a very simple example here. Though what example I'm going to give you is a financial planning example. It might differ. I don't know the person. It's not always look for an advisor who can guide you. 100 minus your age. 100 minus your age. Suppose your age is 30, 100 minus 30, 70. Put 70% of money towards equity. That can be, and depend on equity also 5-year plus, depending on your goal. 30% put in debt, etc. That can be through ETF, through passive fund, etc. And as you get older in the multiples of 5, suppose you're 40, make a 60 equity, 40 debt. Reduce the exposure towards equity, increase the exposure towards debt. Your risk-taking ability goes down with age. Remember that. So this is how you should follow, but it should be a mix of both active and passive, not only active. Passive will balance to give you that little bit of peace of mind. That's it.
Noted, sir. Well versed. We have covered all the topics and the questions patiently. So today we are done for the question. We can officially wind up for that. So just allow me 2 minutes to give a thanks speech to all of you. So on the outset of today's webinar, I'd like to thank each and every one of you to take a time and attend the today's webinar. So I'd like to thank all the wonderful audience for their participation and engagement. So as your question has made the session interactive and successful, we'll appreciate your time and look forward for seeing the future event as well. And last but not least, I'd like to take a moment to express my heartfelt gratitude to our speaker. Thank you so much, Sanjeev sir, for today's webinar, and you patiently answered all the queries asked by our audience today. So a big thanks, and your presentation was truly enlightening, and the chart and the graphs you have presented with the real life scenario was very much helpful to understand the difference and aspects of the active and passive funds, along with the what kind of funds we should look for. So that has a great exposure we have given, and I'll also a big thanks for your patience where you have patient you answer all the questions today.
Thank you
So
so
thank
much.
you so much, sir, and thank you so much all the participants for today's webinar. We will
Thank you so
keep
much.
on meeting and we will keep on interacting for the next session as well. So officially, I can wrap up for the day. Thank you so much for all.